Hello and welcome back. Last week I did a sentiment analysis talking about how I thought the US dollar was going to decline over the next week or so. This week's sentiment analysis is going to be pretty much the same thought, but with more of what actually happened. As we can see on the chart, for the Euro USD, that is exactly what happened last week. The market broke the highest high I had previously, which is shown on the screen in the yellow line. I am going against the market, and that is good and bad depending upon your strategy. Let's move down to the daily chart and actually look at this break. And we can see exactly how the market moved. And it actually moved quite a bit. But that's the point and context of what I've been talking about. When you start trading, when you get into trading, it's not just looking at the next few hours, the next day, or even the next couple of days. Depending upon the asset you trade, you might be trading for a year on the same basic market as I am doing. Now we can see on this chart exactly where the market completely broke my highest high metrics, which is fine. That's good. That just means my system needs to adjust. And that in lies one of the first problems you're going to run into with trading. If your strategy is not dynamic, you are going to be eviscerated. You are going to be wiped out and lose everything. And even having a dynamic strategy doesn't guarantee you're going to make money. One of the biggest problems I have seen with trading is people don't think about where the market is going to be a year from now. The asset you choose to trade is really the most complicated part of the entire process. If you choose a market that is directly shiftable by political rhetoric of any kind, then you have to be aware of the volatility of that and how that actually affects your ability to trade. If you choose a market like I did, the Euro USD, then you're looking at a market that doesn't care about who sits in the office at the moment. What it cares about is interest rates, country economy, or things that last year over year, election over election, long-term stability. That is often where most people make the biggest mistake in what they trade, is they think they see an opportunity, but they don't necessarily see where that opportunity is going to be as the market changes and moves. And that change and move isn't just in the financials. It's in the people buying and selling whatever that market is. That is some of the most difficult areas to actually deal with. I've readjusted the yellow line to the newest highest high. Now let's go back to the monthly and look at the market as a whole. You always have to look at the bigger picture when you're trading. This isn't about a simple situation. As we see on the chart, we can see clearly how a particular pattern formed, and it is literally where I started this cycle. This particular asset I have been trading for the last year. I will be trading it for a minimum of the next year, simply because right now I have $900 in the market. I cannot afford just to walk away from this market without one very huge loss. But that's the consequences of what I chose when I started to trade this market. That's the understanding that when I got into the bigger picture, that I was going to be in this market for a very long time. And that is one of the more difficult aspects of trading. Even if you use a single position stop loss metric, where is the market going to go? Looking back on the chart, and we see the extreme market uptrend and where it went. Nobody expected the market just to go for a 5-month straight rally, but it did. And of course, I accumulated all of the positions I currently have. But at the same time, with the way the current US dollar is and the way the current euro is for their markets, it could just as easily take out my entire order book, meaning my entire everything I'm holding could be sold off. That is a significant concern for long-term trading. My way of mitigating that is with smaller position sizes because it benefits my trading technique. I prefer the always in situation, and I am using negative market correlation to earn on finance rates. It works for me. It may not work for somebody else, and I don't recommend it unless you understand exactly what you're doing, meaning you understand the significance of what this means for your personal trading. For example, as we can see on the screen, I got paid for holding. So for me, this is beneficial. Having all of this works in my favor, at least until it doesn't. And that's part of the risk. At some point, legitimately, I will have a stop loss. I've already had 35 of them in the course of this last year. I have a maximum wall of 73 positions, no more. I am currently at 63 positions. So if the market goes against me and I pick up another 10 positions, I'm going to be taking a stop loss, a hard one, and it's going to hurt. But that's fine. That's my strategy. That's my ability of managing risk. And that's something I planned out 2 years ago when I got into this market. I have been trading this market for 2 straight years, non-stop, always in at some point. So for me, understanding that problem, understanding that risk is critical. And before I actually got into this market, I spent 5 years studying it, running simulations from historic data, learning about the trends and patterns that help me make decisions on a regular basis. Because at some point, the market is going to hand me a loss or more. And I have taken up to 10 stop losses simultaneously because of the brutal and aggressive market shift against me. You have to think about all of that. So in your approach to trading, when you look at the direction of the market, the sentiment of the market, one of the most critical aspects of the market is going to be what happens when it goes against you hard. And it is at some point going to go against you very hard. Some sections might go for you very nicely, but that is how you balance your risk versus your reward. For me, that is multi-positional trading with a very specific type of stop loss technique. For you, that might be a single position, support and resistance, or Bollinger's or ATR, some kind of context that fits your personal risk assessment. But you must always think about, not just today, but tomorrow, next week, next month, or next year. Where are you going to be in your trading at each of those points? Or do you absolutely know at some point you're just going to get out of the market and go find a different one? Again, you have to have that as part of your plan. If you have an exit strategy, you need to have clear rules about when you just say enough and walk away. You have to be able to follow those rules in such a way that you are able to easily see what is going on when you look at your charts. My charts are price only for this. I have a very specific range, and that range is kept based upon volatility, and that range adjusts based upon volatility. That might be different for you, which is fine. But when you look at your order book, when you look at the buyers and the sellers, and you see where the market is, then you get a clear consensus of what steps might help benefit you. And if you do use negative correlated interest rates, then you'll get a various method like I do where you can earn for holding. This does not take place on every pair, and it may not take place on this pair in your country. Always do the research local to your own jurisdiction, because from what I have seen, most countries favor their own pair and direction. For example, in this case, if I was to be long in Euro USD, I would pay a holding fee each day. But the United States is the currency I'm dealing with, and for the United States, I receive interest for holding it, because from the standpoint of the Forex market, the euro is on one side of the scale, the USD is on the other side of the scale. When the euro goes up, the USD goes down. When the USD goes up, the euro goes down. So in this context, these two economies are competing against each other. And the order book shows through buying and selling who is betting on which side to get the best choices. Now, this is a very simplified view of this market, but it's a realistic enough view so that you can see how the actual interest rates play in when you hold an asset. The interest rates are always going to favor your national jurisdiction. Now, of course, there will be exceptions to that and circumstances to that regarding the global markets. But for the most part, that is usually true. And you can find that information out when you go through and look at your market circumstances. From the standpoint of what we have here, I bet the USD in a short position, and the market proved me wrong. But we talked about that, and that's the point. When the market did what it did, and we got this huge upward spike, it went against what I was doing. I had to accumulate more positions. My risk went up drastically, but then it sold off and corrected, and I accumulated real profit. And that profit worked in my favor. That isn't always the case, but that's the point of trading. Risk management. Somebody in London, for example, or Germany, they would be betting on the euro, and they made money and then lost money. This is a zero-sum game in that you profit from somebody else's losses, and somebody else profits from your losses. There's only an infinite number of people in the world of trading, and there's only a definite number. And there's only a definite number or amount of money in the market. And that market changes hands constantly. Buyers and sellers constantly arguing over price, wanting to get the best in whatever direction they are going. So as you trade and as you look at next week, as you think about how your trades are going to unfold, even though we are looking just at next week, just at one particular situation in the market, what will happen? Will next week be as dramatic as last week? I don't know. But that's the point. Nobody does. It's easy to go back and look and see a particular pattern on the chart and think, okay, the market is going to do whatever. But that's never the true case. It's never going to give you a definitive answer that the market's going to do what you want it to do. It's going to do what it wants to do, and you just happen to be on for the ride. Sometimes you win, sometimes you don't, but it's all about how you manage your risk. That's the most critical part of the entire situation. So as we prepare for next week, think about your own trading. Is it a short-term outlook you are looking at? Meaning, once you're done, you want to move on to something else? Or is this something that you want to trade week over week, month over month, year over year? It requires two different thinking methods for each of those. Short-term versus long-term. And even if you trade for short-term profits like I do, meaning you hold for a couple of hours to get a profit, because of the way I trade personally, I still need to think about next year in the market. I need to think about the fact that I'm holding $900 of inventory. What's going to happen to that inventory if the market goes against me hard? That matters. That must be part of your thinking process. That must be part of your sentiment analysis in how you evaluate your risk. As we continue looking at the market, where is it going to go? Well, based upon mathematical principles, based upon supply and demand, based upon where actual people like you and me have their orders, the market has a very clear answer. Most of it is going to remain in this region, but there is a select group that want the region I'm highlighting now. And that is the important part. So the region above 1.18 has a lot of activity, but the region below it also has a lot of activity. Buyers and sellers fighting on where they want prices to be. And somewhere they're going to come to a consensus of how much somebody is going to accept versus not accept. But either way, the inventory of the market is still going to present and project a certain flow. And we see that that flow overall is, looking at the screen, basically this section. Let's see if I can get about the 114 range to the 120 range. So $1.14 to $1.20 looks to be the rough range the order book is indicating is we're going to be at for a while. Will we? We'll see. I personally am going to stay where I'm at because it's profitable. If you're looking at other markets like the British Pound AUD or the Euro Canadian or even the USD Canadian, you need to think about the same thing in their context. This strategy works well in this market. It will fail miserably in the Australian New Zealand dollar market, but not for the reasons you might expect. That market is different and requires a different mindset. The strategy can be tuned, but the mindset is completely polar opposite. Because Australian dollar, New Zealand dollar are basically neighbors and competitors to each other, neither one of them that I have seen gets a clear advantage over the other. Meaning if you go to hold from either side, you're going to end up paying interest. That is a problem to think about. That is a consideration to work into your mathematics. You see, holding is not bad as long as you figure what you pay in finance rates into your take profit, because then you can make up what you hold and what you have to pay for that financing when you make your profit. But you have to be aware of that market specifically. Well, I think I've rambled on enough about this, but share your thoughts. Let me know what you think the market is going to go next week. Do you think we're going to continue to see a push against the US dollar like we saw last week? Personally, I do. I think over the next week is going to be similar to what we saw last week. I think we might even reach higher highs than what we have had. I don't think it's going to be sustained and the market's going to correct. But if you don't have a plan in place, I think it's going to be disastrous for liquidations that aren't planning for any kind of a huge uptick. We've already seen over the last couple of weeks how companies like BlackRock failed to take that into account, and they ended up with a massive $1 trillion liquidation because they didn't plan out the details of their worst case scenario. And I'll prefix that with they didn't plan it out to take into account their own selfish greed. When you're in the market, you have to have an exit. You have to have something in mind of where you get out of the market. At what point is this market just bad? Or you have to have a position size regiment that lets you move with the market and take smaller losses. One of those two ways has to give. You can't stand in the middle and expect the market not to just beat you into the ground. Share your thoughts, leave a comment, let me know what you think. Thank you for watching.